Hello, everybody. Welcome to the Trading with Ashley show. I hope you are too able to get outside and enjoy this weekend in some form or fashion. Sometimes it's just good to get away from the computers for a little while and enjoy nature. But I wanted to talk to you today about how to trade in a bearish environment. It's a question that I receive a lot from my viewers and from my community. In fact, we spent a lot of time this week going through how to protect your portfolio. So for those of you that are seeing red in your portfolio, I want you to realize that that is very normal. It's very natural, and you are in the majority. There are very few people, unless they are professional short sellers, that saw green in the last couple of weeks. The tariff talk, everything that's going on with the macro environment, it causes nervousness. The VIX spikes and our stocks suffer. But I want to provide, before we get into these strategies, and I'm going to give you several, I want to provide a little bit of perspective. You have to be careful not to be too bearish. I want to go over some statistics with you that show you that if you're too bearish, you can start working against yourself. And honestly, it's just best not to be in the market if you are overall bearish longer term. And let's discuss why. If you look back over 96 years in the stock market, so we were talking about 1928 to 2024, it may surprise you to know that if you break it down in 5-year periods, that the market goes up 88% of the time and only down 12% of the time. And if you adjust the research a little and look at 1954, when the economy was really more stable, then the market goes up 90% of the time when you are looking at 5-year increments. And then the severe longer-term downturns that all of us are scared of, those are even more rare. Those actually only happen once every decade or two. So we're looking at 1929, the year 2000, and the year 2008. I want to share with you why the stock market traditionally does go up over time and in such great percentages. Let's break it down. For starters, the American economy, well, it's the strongest in the world. Our GDP, it averages a 3% growth annually. And stocks reflect that. They go up on average 10% annually. And this is due to the returns that they're seeing with the growth of their businesses plus their dividends. So if you were out of the market for the 10 best days of any given year, then your returns are dismal. So I want to encourage you and let you realize that although we're going through a volatile time and there's a lot of bearishness, at least sentiment right now in the market, I want you to be careful not to overhedge yourself into not having a profit. But we're going to talk through what percentage of your portfolio should you use for a hedge, what percentage of your portfolio should be in cash, what is an ETF that's considered a value play and where you might see money start to rotate into until things stabilize a bit. And then finally, how can you actually profit from the market going down? I am going to show you when I purchase puts, how I select the right put to purchase and the right time frame. And then for those of you that want a little bit more complicated dynamic with the purchase of puts, I'm going to show you a put debit spread and how it might be used in your portfolio. Now for the hedging talk. Let's talk about my very favorite hedge, and that is cash reserves. And the reason that's my favorite hedge, it's because of everything I just shared with you. The market trends up over time. So if you can grab some of these stocks on the cheap when they are at a very good fair price, fair value in their price life cycle, and they're good quality companies, then you are going to be ahead as soon as the market decides to turn back around and start heading back up. So I'd hate for you to miss out on some incredible opportunities. Now, me and my students, we have been selecting some wonderful stocks that I know in the next couple of years we'll look back and say, gosh, I wish I would have bought more of these quality companies. But you do have to have cash to do it, right? So if you don't have an influx of cash with a W-2 job or a side business that is allowing you more cash to invest in these quality companies, then you have to raise cash, and maybe it's through your portfolio. Well, how is that best done? What I like to do is I like to sort my portfolio from top to bottom, and then if I'm wanting to raise cash, I start trimming my winners, those positions that are in profit, whether it be the stocks themselves, whether it be sold puts, whether it be calls or skips. I like to start cashing up and taking profit. Those that did not take profit in the last couple of weeks, I know they're kicking themselves. So this is an exercise that you want to do with your portfolio at least once a month, once a week preferably. Then it's time to cut your losses. When you are looking at red in your portfolio day after day, week after week, it does something to you emotionally, and it really is discouraging. It's a constant reminder that you're failing as an investor, and I don't want anyone to feel that way. But it also is really good to trim your losers because the money that's remaining in that play, it can be redeployed in a more high conviction play, and you can more than make up for that loss. But if you just keep watching it go down, hoping and praying that it's going to turn around, but there's no real fundamental story or catalyst to get it there, then that's a loser's gain. You just need to cut your losses. Most successful investors, I venture to say all successful investors, know when to cut a position that's just not working out like they hoped it would. Now that you're all cashed up and ready to go and you know how to generate that cash, let's talk about a really good value ETF that you may want to consider as part of your portfolio investment with that cash while we wait out the storm. I love the Vanguard funds, and one that you may want to consider in a down market. Instead of growth, this is the Vanguard Value Fund. It's VTV, and let's take a look at it and how it performs over time. So let's look at 5 years. All right, we're looking at a 52% return. So I want you to realize this is not as aggressive as, let's say, the Vanguard Growth Fund, which is VUG. I'm going to show it to you. So as you can see, the growth fund went up 114%. It doubled the return of the value fund. But if you're just going to be in this for a short time, it's a real good place to place your cash. So let's take a look at what's in the value fund. We've got quite a variety. We have financial services, which makes up the vast majority of it. Healthcare is another big piece. Industrials, technology is still in there. It's just a smaller percentage. You have consumer defensive and energy, and then you have a lesser percentage of the others. Let's look at the top 10 holdings. And we're looking at JP Morgan Chase, Berkshire Hathaway, you've got Broadcom, United Health, ExxonMobil, Walmart, Home Depot, Procter & Gamble, Johnson & Johnson. And then finally, we have one that I don't know that you ever heard of before. It is a pharmaceutical company. Its ticker symbol ABBV. Now let's get into a paradigm shift with puts. I talk all the time about selling puts, and I definitely have not given that up because that is the bread and butter of the wheel strategy, and it's where I make most of my money, especially in an environment like we are in right now. Puts are actually more expensive, and as the option seller, I'm the benefactor of that increased volatility in puts. So never abandon your core strategy. But it is appropriate at times if you see on the horizon that things may be heading south to take advantage of that and actually profit from purchasing a put. But there's some key things to consider when you're purchasing a put to keep you safer. Time decay can be your biggest enemy when you are purchasing a put. So I am going to take you through now what I look for and how to select the right put if you are going to buy one either on a sector or if you're going to buy one specific to a stock that you may be heavily invested in and you want to be able to hedge that stock continuing to go down. So here is how you decide what put to buy and what expiration date to use. Now, I've talked a lot about time decay, so you want to go out at least 3 months. That is going to protect you from aggressive time decay. I like to go out just a little bit further. If you want to hedge a specific position, maybe you have a lot of Tesla and you want to see a little bit of green when everything else is going down, if you think it's going to continue to pull down, then you would pull up your ticker symbol and you go to the option chain. For this one, I am looking at the June timeframe as an expiration date. And then you come to the right side of your option chain. This is where the puts are. We're typically here. We are selling puts, but this time we are going to be a consumer of puts. We are buying the insurance. Tesla is currently trading at around that 290 mark. So what you want to do, you want to continue to consider this delta right here. But when I'm buying puts, my intention is to cash these in rather quickly. So I don't like to overspend on them because, like I said, it could go right back up and then you've paid a lot of money and you can't take any advantage of it. So I actually like to look at something around the 0.5 delta, whereas when I am buying calls, I'm more aggressive with my deltas. I like to look at something closer to about the 0.7 or 0.8. So if I'm going to look at that, then I want to also consider my volume and open interest. So you can kind of see where institutions are lining themselves up too if they are doing the same. And so right here, you have this 320 mark. That's at the 0.5 delta. And then right down here, you have a similar dynamic with the 340 mark, but it's a lot more expensive. So in this situation, if I have a lot of Tesla and I think it might keep going down, I will probably more than likely settle in right here at about this 320. Now, this is going to cost me. So it's going to cost me at this point $5,300 to place this hedge. Now, what will happen if Tesla continues to go down, then what I paid $5,300 for, it will continue to go up in value. How much? Well, it shows you right here on the delta. It will go up about $52 for every dollar that Tesla continues to decline. And then what I can do is once this has profited, if it does keep going down, once this has profited about 25%, it might be time to go ahead and start trimming the amount of puts that I have and actually taking a little bit of profit on those. But if it continues to go down and it goes down fast, you might want to leave a runner or two if you've purchased more than one. Now, of course, you don't have to just stick with one particular stock. You can do an entire sector. If you think that the QQQ, the NASDAQ, is going to continue to suffer with the volatility, then you might want to do something similarly. So right now, I'm looking at that June timeframe. You could go a little bit further out. It'll be more expensive, but it'll cover you for a longer period of time. And you do the same thing. So now I'm scrolling all the way down to where we currently are, and we're sitting right here at about the 510 mark. So I'll come down here, I'm looking at my deltas, and there we go, right there. It starts at around the 520 mark. These strikes are a little bit different. They're not clean strikes, but still you can see right here, 0.5, and it looks like you have a lot of institutional buyers going ahead and lining their bets up here as well. But this is interesting. Look right here at 510. This one might be really good. You've got 36,000 in open interest. It's not as much of a delta, but it's a lot less expensive too. So in this case, based on what I am seeing with such a significantly higher amount of open interest, I might settle in right here at this 510 mark. This one will cost me $21 a share, so you're looking at about $2,100 for every put that you purchase for the QQQ expiring in June. Now, how much should you hedge? Because that's an important factor. You don't want to hedge 100% of your portfolio or your position because, like I said, the stocks tend to go up over time, especially quality companies. So you might consider taking about a fourth, 25% of what you've invested in any one sector or any one stock and creating the appropriate hedge with about 25% additional funds. That way, when it pulls back, you will be able to profit from that hedge. But when your stock or that sector decides to turn around, you won't be so hedged that you're not enjoying the upswing again. Now, there's one more thing I want to show you. This is called a put debit spread. Now, I've showed you in some other videos how to do a put credit spread or a call credit spread, but this one's different. After all, if you're going to be buying a put anyway and paying money to hedge your bet, this is a way that you can do it that's going to cost less. Now, it's going to limit how much you can make as the stock pulls down. But because it doesn't pull down as much as it goes up, this may be an appropriate hedge that will cost you less. And it also removes the mystery of when do I take profit. This is a defined profit strategy. And I like this because you can have a tendency to get greedy when you see something is making money as it's going down. Then you can think it's going to just keep going down further and you never know when do I actually take profit. The reason I like what I'm about to show you is it is a defined max profit. It's real easy to understand when you should get out. Now, what I'm about to show you is a put debit spread. It's going to make your put less expensive, but there will be a defined amount that you can make. So now I am looking at the August time frame. I'm still on the QQQ. So let's get started with this particular trade. So I'm still interested in my open interest in volume. It kind of helps to drive my decision. And when I look right here at the 525 mark, this might be a really good spot to get started. So this would be the one that I am going to buy. We're sitting at 0.15 on my deltas. But then what I want to do is I want to turn around and sell one that is a little bit lower. So in this situation, I'm looking right here at 520. So I might decide to sell this one. Let's send it to a ticket so you can see how much this would end up costing you and then how it works in the way that it moves. Once you send it to a ticket, here's what it looks like. You've got the same expiration date. This is August 15th. You've got two different strike prices. 525 is the one that I am purchasing. And then you have your 520 put. It's the one that I'm selling. I want to do an even number, so here we go. And then it's a net debit this time. So I am going to pay $240 for this debit spread. That's the most I can lose. It's what I have paid, the $240. So it's a defined loss. Well, how much can I make? Here's how you figure that out. What you do is you take the 525 minus the 520, and that's $5, but you have to account for what you've paid. So what you'll do is you'll take your $5 and you'll subtract what you paid, $240, and the most you can make in this scenario is $260 a share, so $260. So you're paying $240, but you can make an additional $260 if your ticker symbol continues to fall down through your strike prices. Now, when will I potentially reach that max profit? I'm looking at an option calculator. So if we keep having the QQQ continue to decline, then you can see down here when you reach your max profit. Here it's showing as 259. So if it comes down to 428, we've maxed out how much we can make from this play. And so you want to manage this appropriately. Be prepared if the stock or ETF continues to go up, you're going to see losses, but this is a hedge and it's a defined loss. So you may want to hold on to it at least until we get closer to the expiration date to determine what to do. In this case, I might buy a couple, and then once I see one of them starting to profit, I'll go ahead and take profit on that, and maybe I'll let the other one run until potentially it reaches its max gain. I hope you found this helpful. Please do me a favor. Go ahead and share this with anyone in your circle of influence that they like to trade stocks, and they're wondering, what do I do? What do I do? I feel helpless when the market's just going down, down, down. I think this might serve as a real good reminder to them of all the different things they can do to take control of their portfolio, and then they can actually breathe a little bit easier. They can be calm, cool, and collected like you are now and be able to face the markets with confidence. Remember, if you're with me, Trading with Ashley, there is no trader left behind. Now, if you would like to watch a video that I produced on what to do when the markets are riding high to prepare for a rainy day like we're going through now, you can watch that video right here.